Welcome to the Deep Dive, where we try to cut through all the noise and really focus on the insights that matter for you. And wow, do we have some big news today, really monumental stuff shaking things up. The Federal Reserve, they've just lowered interest rates. Now, this isn't just another headline, right? It feels like a real economic tremor, and you can already see the ripples hitting the investment world. So for this deep dive, we're going to zero in on what this big shift could mean for your strategy, especially, in the tech sector. It's so dynamic right now. Our guide here is a really timely article. It's from Lucas Downey over at moneyflows.com, just published today, actually, September 18th, 2025. It's called When the Fed Cuts Rates, Buy Semiconductor Stocks. So our mission today, pretty clear. We want to unpack Lucas Downey's arguments, really pull out the key insights, maybe some surprising facts too, all to help you understand why semiconductors specifically are being flagged as such a huge opportunity right now. What makes this rate cut so interesting, I think, is that it's not like they're reacting to a weak economy or anything. Markets are strong, really strong. So how does that combination of, strong economy plus easier money amplify the opportunity in semis, maybe more than other areas?
That's exactly the question, isn't it? And it's what makes this moment, well, pretty unique, as the source really emphasizes. I mean, you've got markets hitting all-time highs. The economy isn't just okay, it's actually humming along, booming even. It's continuing this strong rally that, honestly, not many people saw coming quite like this. So this strong backdrop, it's precisely why the advice, buy semiconductor stocks, isn't about trying to prop up a lagging market. It's more like a signal for maybe turbocharged growth. The conditions are already there for expansion, and this rate cut, it just acts like a powerful accelerant. It suggests the demand for those key growth drivers, especially tech, is just incredibly solid.
Yeah, it's a fascinating setup. Definitely not the usual rate cut story. Okay, so let's dig into the core argument the article builds on. The AI revolution, I mean, it's everywhere, right? It's in full swing. And it's pushing huge amounts of capital into what the source calls these high-quality tech stocks. We're talking the big names, the Ulster companies mentioned in the piece, NVIDIA, ticker NVDA, Broadcom, AVGO, Lam Research, LRCX, and Lele Corp, KAC. These aren't just popular stocks. They seem to be the kind of foundational engines for this whole AI economy. And the numbers, wow, when you look at the data, it really shows the scale of this. The S&P 500 Semiconductors and Semiconductor Equipment Index, it's up an incredible 81% since its low on April 8th. 81%. That's a number that makes you sit up and pay attention. Does the article give context on how, exceptional that is, even for tech?
Oh, it's absolutely extraordinary. Even for the tech sector, which sees big swings, 81% is huge. It really speaks to this unprecedented demand. And the article stresses this isn't just a quick blip, it's sustained. I mean, to show how relevant it is right now, Lucas Downey points out that just yesterday, a full third of all the equity inflows, money flows tracked, went into technology stocks. 1/3.
Wow.
Yeah. So it's not some fleeting trend. It's this consistent, powerful flow of capital into this specific group. Day after day, week after week, really. That kind of sustained buying. It's a pretty clear vote of confidence from investors, both big institutions and individuals. And the article also mentions it's not just any tech stocks getting this money. It's focused. It's flowing into what they call top-tier companies with accelerating earnings, often ones with a high MAP score, maybe 70 or more, signaling these are quality outliers.
Okay, so AI is driving the demand, the money is flowing into these top companies, and now the Fed cuts rates. So what's the critical link here? For our listener, is it just, money's cheaper now? Or is there something more going on that really boosts this specific sector?
That's a great question. It's definitely more nuanced than just cheaper borrowing. Yes, the source makes it clear lower rates help growth because capital's easier to get. That helps the bottom line directly, reduces borrowing costs. Simple enough.
Yeah.
But you combine that with this massive AI revolution, which, remember, needs huge investment up front. R&D, building out infrastructure, scaling up. When you put those together, the article calls it a cocktail of massive equity gains ahead. That's the quote.
A cocktail, huh? I like that analogy.
Yeah, think about it. The growth engine was already running hot, right?
Right.
Now the Fed's basically injected it with higher octane fuel. Companies aren't just seeing their old debt get cheaper. They're finding it much easier, much more attractive to fund the huge new investments needed for the AI boom. So it creates this really powerful synergy, a strong catalyst.
Right, that makes sense. It clarifies how these different forces work together. Okay, let's unpack this a bit more then. The article, Lucas Downey's piece, it breaks down 3 big reasons to favor semiconductors right now. Let's take reason number 1, seasonality. Now this really caught my eye. The article suggests history points to a strong period coming up for semis. What does that historical data actually show? And why should we care beyond just, what month it is?
What's fascinating, and the data goes way back to 1995, it consistently shows that this group, the S&P 500 Semiconductor and Semiconductor Equipment Index, it tends to have its best performance on average in the fourth quarter.
The fourth quarter, okay.
Yeah, we're talking an average gain of about 7.83%. And interestingly, the third quarter, which historically tends to be the weakest for this group, that's just about wrapping up now.
Ah, okay. So worst is behind us, best potentially ahead, historically speaking.
Exactly. Now, of course, seasonality alone. You never make an investment decision just based on the calendar, right?
No.
But when you layer it on top of these other really powerful fundamental drivers we're seeing, it adds another tailwind. It's like, having the wind at your back when you're already running downhill.
It helps. That's a good way to put it. Okay, so seasonality is one factor. That brings us to reason number 2, earnings acceleration. The article uses some strong language here. It talks about the mind-boggling pace of earnings acceleration in semis, driven by what it calls this multi-year super cycle in AI. Mind-boggling. That's quite a word. Can you give us some context on just how aggressive these earnings projections actually are? Why is this so fundamental?
Absolutely. And mind-boggling might not be far off when you see the numbers the article lays out. They are pretty remarkable. Okay, so for the S&P 500 semiconductor industry, earnings per share, EPS, estimated at roughly $209, let's say 208.71 cents for 2025.
Okay, $209 for 2025.
Right. But here's the kicker. For 2026, that's projected to jump, get this, by 34%.
34%.
34%. Up to about $280.
Right.
$280.02.
Oh.
And it doesn't stop. The estimate for 2027 is another jump, maybe 18%, up to around $332, $331.70. So these aren't small increases. These are massive, sustained leaps in expected earnings, far beyond what you see in many other sectors.
Yeah, no kidding.
And this accelerating earnings story is the fundamental reason, as the source puts it quite vividly, that money is violently flowing into high-quality semiconductor companies. Investors aren't just chasing a vague trend. They're chasing real, measurable, and rapidly growing profit.
Those numbers really do paint a picture. You can see why the money's flowing there. Okay, that's compelling. Now let's hit the third reason, which the source calls the biggest catalyst of all. Reason number 3, Fed rate cuts happening in a non-recessionary environment. The article points to a really powerful historical pattern here, and you're going to want to hear this. Okay, so data from 1995 to 2025 shows when the Fed cuts interest rates and the economy is not in recession, and crucially, it doesn't fall into one within the next 12 months. Under those specific conditions, semiconductor stocks have seen, wait for it, a staggering 71.6% average 12-month returns. Let that sink in. 71.6%.
71.6, yeah, it's a truly staggering figure.
Absolutely incredible. What's the economic logic there? Why such a powerful boost specifically for semis when rates fall but the economy's strong?
It highlights a very specific, very potent market setup. Think about it. When the Fed cuts rates during good economic times, it's not usually a panic measure, right? It's not trying to save a collapsing economy.
Right, it's different.
It often signals confidence. Confidence that growth can continue, maybe even accelerate, with slightly easier financial conditions. So for semiconductors, this creates a kind of perfect storm, a dual benefit. First, that lower cost of capital we talked about. It encourages companies to invest even more aggressively in R&D, expansion, all the stuff needed to meet that huge AI demand.
Okay, fuels the investment side.
Exactly. And second, because the economy's healthy, non-recessionary, well, that means the end users, the consumers, the businesses buying the gadgets and servers powered by these chips, they're also doing well. So you have strong end market demand too.
Ah, so it hits both supply, investment, and demand.
Precisely. The source explicitly says this unique combination of factors, this specific scenario,
Yeah.
that represents the opportunity in front of you today. It's like this historically validated sweet spot for potentially getting significant semiconductor exposure, hitting the jackpot of economic conditions for this sector almost.
That's a really crucial distinction. It explains why this rate cut in this environment might be particularly auspicious for semis, based on history. Okay, so what does this all mean for you, listening right now? Let's quickly pull together the key takeaways from Lucas Downey's analysis. We started with the Fed's rate cut, happening, remarkably, when the economy is actually surprisingly strong and resilient. We looked at the AI revolution, undeniable, powerful, driving incredible demand. We saw evidence of huge, consistent money flows pouring into high-quality tech, especially semiconductor stocks. That shows real investor conviction. Then there's the seasonality factor, potentially favorable as we head into Q4, which historically has been strong for this group. Add to that the really impressive mind-boggling earnings acceleration projected for the next few years. And finally, maybe the biggest piece, that historical pattern. Staggering average returns for semis when the Fed cuts rates outside of a recession.
Yeah, it's quite a confluence of factors.
He really is. A confluence that Lucas Downey argues creates a very unique opportunity right now.
And just thinking a bit broader here, while the source definitely makes a clear, compelling case for semis based on these points, it's still really essential for you, the listener, to think critically. How do these trends fit with your own view of the market, your understanding of innovation's path? Remember, market commentary like this, it offers valuable insights, flags potential opportunities, right? But it's never personalized financial advice. And as always, past performance doesn't guarantee future results. But understanding these connected pieces, the rate environment, the tech cycle, the money flows, it definitely empowers you to make more informed decisions.
Absolutely well said. Critical thinking is key. So as we wrap up this deep dive, here's maybe a final thought for you to chew on. Okay, beyond semiconductor stocks specifically, how might you start to identify other sectors, other companies that could benefit from this combination? This mix of loosening monetary policy from the Fed and these ongoing relentless tech advancements, especially in AI. What new opportunities might pop up as these two really powerful forces continue to reshape the whole economic landscape around us? Something to think about. Until next time on The Deep Dive.